Welcome back. We continue with our results analysis, and it's another good set of numbers that we are looking at from MMFSL. Their net interest income has come in above street estimates. Their asset quality is the best in 8 years. Loan book has recorded a good 31% growth. Ramesh Iyer, Vice Chairman, Managing Director at MMFSL, joins us. Good morning, Ramesh. Thank you very much indeed for joining us. Well, first up, let me tell you what investors have been telling us, analysts have been telling us. What is very heartwarming for them is that after a bit of erratic move by in the results in the last 3-4 years, this year for the last 3 quarters, it's been, steady, constant, good growth. Is this a maintainable rate?
So I have been talking about it even when there were some bumpy rides that we were having, that when you do a lot of work in semi-urban rural market, you do expect that this kind of, bumps happening because of the market conditions out there, and was in nobody's control when we had the COVID wave 2 when things really went bad. But as a model, we are very, very strong. We have a very deep reach. We have a good customer connect. And therefore, we do believe that maintaining this kind of growth when the market conditions are favorable is absolutely doable and possible.
What is the smell you are getting in terms of market conditions now? Because your tractors has actually contracted. The loan book has contracted a bit. So how is the demand looking like? Can you repeat this kind of a performance? It's a 49%, of almost 50% growth in year-on-year terms. What are the, at least the next 2-3 quarters looking like?
So clearly, we are seeing a lot of traction out there in every economic activity. We are seeing use of asset is very, very high. The footfalls are continuing to be very interestingly robust. And also the pre-owned vehicle is showing phenomenal demand out there. And, why do pre-owned vehicles show so much demand? For the low cost of investment, the returns are, the freight rates or whatever else is similar to that of a new vehicle. So people who probably have a short-term use will all go for a pre-owned vehicle. So overall, we see good demand out there. Sentiments are very positive. Tourism at its best. People movement highest happening out there. The monsoons have been favorable, while there are some discussions, but the water levels are pretty good. And the infra is doing well. So what else one asks for rural to do well? I think every front it's doing well, and we therefore believe. But the last comment would be, the price increase on vehicle will be another to look at when the disbursements will grow, because for the same volume, you will have higher disbursements because the price of the vehicles will go up.
No, I was coming to that. There is a likely price increase, especially in EV vehicles, but in others as well. Would you fear that will temper demand?
I don't think so. See, one should look at from the use of the vehicle. See, we work with a lot of this earn and pay segment, and they're all asking for more vehicle because the need is so high out there. And I just laid out various segments which is doing well. So when there is so much of demand up there, I don't think the price of the product, because these are not 1-year product, right? They use it for 5 years, 6 years. And the price has to be seen as a distributed over that period of time. And we don't see that the price increase is going to have any impact on the demand big time.
Okay. More general, now coming to your spreads, 7.4 is still good, though it's 20 basis lower than, a year ago. How do you see that panning out? After all, the cost of money is rising.
So one should look at it. 200 basis point is what we saw as an increase over the last 1 year or so. And in spite of that, we have maintained the margin. It only means that our ALM match is so good that we are not to incur the entire cost of borrowing. We had an impact of just about 60-70 basis point in terms of impact, which was almost passed on. We don't expect that the cost of money is going to go up any further, or even if it goes up, maybe a 25 odd basis point. In the meanwhile, we've got AAA ratings, so some of our borrowings cost has come down by at least about 20 basis points because of the rating change. We also, many of our assets qualify for the PSL borrowing, therefore there's a demand out there for that. And if we do see that the increase is beyond 25 basis points going forward, there could probably be an increase to customer also to the extent of at least 20-25 basis points. Therefore, protecting margin is not our concern at all at this stage.
Okay, so 7.4 maintainable, you're saying?
Yeah, it's definitely maintainable. We don't see that at all.
Okay.
As a problem.
No, and I'll tell you why that question comes, because OPEX is up 23%, cost to income ratio is up a good 400 basis points over a year ago. So, I mean, why these costs? Why are these costs rising?
So one is it's a conscious investment in technology and people capacity, and that will all yield benefit as we go along when we look at even much larger balance sheet. Also, one has to compare these kind of cost incurred with the benefit that it has already brought in. I mean, look at the collection efficiency, look at the NPA drop. They all require some cost to be invested for recovering from all of them. So therefore, one should also look at where has this benefit gone immediately, rather than just looking at it in one line item where the cost has gone. But some of the costs that we have incurred are a very cautious incurrence, and we'll see the benefit of it. As the balance sheet starts to grow with this cost already invested, we are looking at a 2.75 to asset as the number for the OPEX.
Oh, okay. Unsecured loans, how much is it? I'm asking because the Reserve Bank has cautioned lenders about not increasing their unsecured loans.
I mean, you look at our book is close to about 82,000 crore and we hardly have anything. It's a rounding off difference number at this stage. We are not a significant player in the unsecured loan space at all.
Okay.
And even if we were to get into, let's imagine we do some 2,000-3,000 crores of unsecured loan for a year or so, that will be a very, very minuscule number in the overall AUM.
Finally, would you need capital, Ramesh, anytime now? Your CRAR has gone down a bit. Obviously, you are using up capital, but will you be wanting to raise? After all, markets are in a kind spot, barely 4% away from all-time highs.
No, look at our even tier one capital. I think we have yet to consume sufficiently. At about 20% capital adequacy, we don't really raise capital, and we are making sufficient profits, which are also getting added back to the net worth. So we don't have any plans immediately, at least for the 2025 growth plan that we have put out. We don't need to raise capital.
All right. We will leave it at that. Ramesh Iyer, pleasure speaking with you, and all the very best for continuing this very good performance. The market is rewarding it. It's a 5.4% jump that the stock has seen.